When you invest in a publicly traded company, you are essentially giving custody of your hard-earned money to the management of that company. So you better be confident that they are good at their job. In this video, I'm going to share how we assess the capability of a management team by looking at what we consider to be their most important responsibility, capital allocation. Hi everyone, I'm Sam. Thanks for tuning into our channel where we explore achieving wealth and financial freedom through a three-part strategy. Earn more, spend less, and invest the rest. If you've watched any of our investment videos in the past, you know that whenever Chris and I are considering an investment opportunity, we always ask, is there honest, capable management in place? But how can you tell if management is honest and capable? In today's video, we are going to focus on the capability side of this question by looking at how the management team allocates capital, which, in Chris and my opinion, is the most important job of a manager and the #1 marker for how you can tell about a manager's capability. As I mentioned at the beginning of this video, when you are invested in a publicly traded company, the management of that company becomes the custodian for your money, and you want to make sure that they are allocating that capital in a way that is going to benefit you most as an investor. There are 3 primary ways that management can allocate capital. 1, they can pay dividends to their shareholders. 2, they can repurchase their own shares. And 3, they can reinvest that capital back into the business to help it grow and become more profitable. Each of these options can provide long-term benefits to shareholders. And understanding how management allocates capital is a great way to assess their capabilities within their roles. So let's dive into these 3 options in more detail, discuss some of the pros and the cons, and some of the red flags that you need to look out for as an investor. All right, so let's start by talking about using capital allocation to pay dividends to shareholders. The main advantage of dividend stocks is that they pay cash flow to their shareholders, and typically this cash flow comes on a quarterly basis. This is particularly appealing, particularly if you are a bit older, if you are a retiree, because you could be relying on that cash flow to help supplement your retirement. The disadvantage of a business that pays dividends is that it puts the responsibility of compounding onto the shareholder. What I mean by this is that once you get paid your dividend, the money is now back in your bank account, and it's your responsibility to figure out a new way to invest this money so that you can maximize your return on investment. The other downside of dividends are the tax implications. So essentially, the company is going to pay corporate taxes on the profits, and then when you receive the dividend, you're also going to have to pay personal taxes. So essentially, that money is being taxed twice. Let's talk a little bit about the red flags associated with dividend-paying companies. The first and biggest red flag that you need to look out for is a high and unsustainable payout ratio. The payout ratio is the percentage of earnings that are used to pay dividends. The lower the payout ratio, the more sustainable it is for that company to continue to be able to pay out those dividends, given that it continues to be profitable and continues to grow. This is really important to understand because it is not uncommon to see payout ratios of 100% or even more. What this means is that the company is using debt or using money from its balance sheet in order to pay these dividends, and that's a big red flag. All right, let's talk a little bit about stock buybacks. So they are exactly like they sound. Stock buybacks are when a company repurchases its own shares and retires them. For you as an investor, this means that your ownership share of the business increases in relation to the amounts that you had purchased. Stock buybacks add shareholder value, but they do not add value to the business. Let me say that again. They do not add value to the business. And therefore, companies should never, ever use debt to facilitate stock buybacks. Remember, when it comes to debt, it should only be used to increase the profitability of that company. Also, remember that the money a company is using to buy back its own stocks is in fact your money as an investor, and therefore you want to know that if they are buying back their own stocks, they are doing so at a price that you feel comfortable with. Now, if you are a value investor like us, you would never go into an investment without understanding what the intrinsic value is for that stock. And if you're going to buy shares, you want to get it at a discount to its intrinsic value. So if you've done your homework, you're going to know what price is acceptable in order to buy those shares. And you should maintain those same expectations for the management when they are considering stock buybacks. If you want an in-depth tutorial on how we calculate intrinsic value, check out our Apple video, which I will link below in our description. The third way that management can allocate capital is through reinvestments into the company, and this can include things such as research and development, expansions, mergers, and acquisitions. For long-term investors who are seeking efficient growth in their portfolios, this is really the best option. When you hear investing gurus say that they are looking for compounders to invest in, this is what they're actually talking about. We love to see companies that are able to reinvest large amounts of cash back into their business in order to promote growth and to grow their profitability. Personally, we are looking for a company to have a return on investment capital rate of over 10%. This is a really great sign that they have very capable management. We also want to see consistent growth in their earnings per share. Companies are able to do this by investing in developing new products, investing in new markets, by refining their processes, systems, and operations, by investing their capital into research and development. They're looking to increase their margins, and if they acquire another entity, it's with the objective to make them more profitable and the company that they acquired more profitable. Remember, I've said this word many times throughout the video. Profitability and increasing and growing that profitability is the name of the game. One red flag that I want you to look out for when it comes to reinvesting capital into the business is managers who are just growing for the sake of growth. They're pushing an agenda to get bigger, not necessarily better. So it's really important that when you look at the activities of a company's management, you want to see that what they're doing is actually growing profitability, not growing their ego by having a super big company and just taking over other companies for the sake of it. They need to be doing activities that add value to the business and thus add value to you as an investor. All right, guys, that's it for me. I hope you enjoyed this video and found it useful. If you did, be sure to give it a like and subscribe to our channel. As always, we welcome your comments and your feedback, and we will see you next time. Remember, earn more, spend less, and invest the rest.